So Federal Chairman Jay Powell is hanging out with Congress again for a second day. And it's really interesting because the mood on Wall Street has changed. The headlines are very clear. We'll take a look at this, guys, together. Fed Chair Powell returns to Congress for second day of hearings. And what I mean by clear is, you can see this, a recession indicator just flashed its loudest warning ever as Fed Jay Powell signals higher rates. And the crazy thing is that we've been getting these basically warnings that recession's coming, but it hasn't come. And so then you had some people saying, well, I guess it's never going to come. And it's been really, really wild. The other thing too is that sort of as I mentioned before, the mood of Wall Street has changed, mostly because it looks like the Fed is more hawkish than they had expected. Although on this channel, as you guys have been talking about, I've been saying, hey guys, listen to the Fed. I'm not making it up. Listen to what they say, and they've stuck to their word. The other thing too that's been going on in terms of headlines, you can see here, global investors contemplate fallout from U.S. rates reaching 6%. Now, when we talked about this earlier, I believe it was last week, there was a really important article, which I think a lot of people skipped over. We didn't because we're cool like that. But basically it was academics, right? Meaning essentially professors, economists. Then they were saying essentially it could be essentially the top rate could be more like a 6 to a 6.5. There was 5.5, 6, 6.5. There was no mention of a 7%. I'm just keeping it real. So as of now, that might not be on the table, right? But when you're printing in, essentially this is Bloomberg here saying that, people are starting in the investing community are start talking about 6%, stuff like that. And remember too, oftentimes people say things in public for show. So, their real projections could be a little bit worse. Whereas, the 6% is something that they're willing to say in public. But economists, I mentioned before, have been saying 6.5. So we'll see. And this is actually BlackRock is even saying 6%. Here's another headline. Deepest bond yield inversion since Volcker suggests hard landing. And again, this is when the 2-year is above the 10-year. But it's been like that for a while. So this is why it's been so weird. Because normally, you would see this and you say, okay, we're going to recession. In general, such inversions preceded economic downturns by 12 to 18 months. So, we could still be in kind of this hanging out period of okay, the yield curve inverted, right? 2-year above the 10-year. And then we wait 12 to 18 months for the, essentially the downturn to begin. We're all kind of expecting it. And it's okay, so where is it? Here's the thing, sometimes it takes a while for this to seep in. The basic idea, think of it this way, is you raise your interest rates by, 25 basis points, nothing happens. Raise it by a full basis point, again, nothing happens, right? And you keep raising. It gets to a point to where suddenly you start to affect people's wallets, right? Suddenly consumers are oh my God, I can't afford that mortgage anymore. Oh my God, I'm not buying a car anymore. Oh my God, everything's just too expensive, right? You get to a point to where it really starts to affect people's wallets. And, we keep raising rates. So it seems like it should happen sooner or later. One thing that's been going on as well, you can read this here. Traders upgrade the odds of a half-point rate increase on March 22nd from about 1 in 4 to about 2 in 3. And this is another sort of projection on that. The basic gist is, what are the chances of them doing a 50 basis point rate hike, right? 0.5% rate hike. And this has actually gone up. So we're at the 72% as of now. That's sort of the probability as the market is betting on. This just gives you an idea of why this is so funky, is because, here, was about March of last year, we did a 25. Then we did a 50, then 75, 75, 75, 75. Then it looked started to slow down. And this is sort of when the markets are oh, okay, maybe we're coming out of this thing. And I never said that, right? And you guys know this, I never said that. I did say the market be crazy. I kept saying that all the time. And you're okay, so the market thinks that, maybe things are going to top out. And it just was weird. The whole thing was been weird to me, to be perfectly frank. And then we went to a 25, and then there's been some talk that, okay, maybe they're just going to do 25, 25, 25, then it'll be done. And some people are optimistic about that. And so this is sort of why it's funky, is that if indeed the Fed's what, we got to do a 50, which is, a reverse direction of what they were doing. That's sort of why the market would be kind of whacked out, or wigged out, however you want to say it, because it's different than what everyone's anticipating. And remember, the stock market and all of this kind of game is all about anticipating the future, predicting the future, right? And so this really throws things out of whack. Who knows what they're going to do? And we've noticed that, for example, look at this headline. Powell's shift on rate hikes comes as officials prepare for the March meeting. It's the key word here is shift, because it's just been a real change in language, both from not just Powell, but from other Fed people as well. They've just been starting to really say, hey, what about 50? 50 starting to sound kind of good. What do you think about 50? Like they telegraph kind of what they're thinking about doing. So this is sort of why when you see the headlines like really all switch over to this, it seems like it may be a real possibility. JP Morgan fears half-point hike would confuse the market, right? I'm confused also. What is going on? And then you got this other headline waking up this morning. No exit ramp for Fed's Powell until he creates a recession. That's just something that economists are reviewing on CNBC now. Goldman Sachs is saying more like 5.5 to 5.75% could be the top. But like I said, guys, the key one that we looked at before was more like academic people were saying 6.5% would be essentially the top. The thing that I want you to think about is on these kind of situations, and we were talking about this in comments just earlier today before, is I don't have any particular reason to say, hey, it has to be this percent, or this, hey, it has to be this percent, or hey, you have to do this, or hey, you have to do that. It's because I'm not really paid by that. What I mean by that is like if you ask people on Wall Street, hey, what do you think the rate's going to be, and they're going to say, oh, it's only going to be a little bit more. Everything's going to be great. Keep giving me your money so I can make money on on the management fees, right? So Wall Street makes money off managing your money, and that's sort of why they try to temper their language. And then the Fed, they temper their language because essentially they don't want to freak everybody out, right? So they're always trying to like be real calm about these things, and they always give a lower projections. Whereas I was telling you guys, say academic people, which tend to be more neutral, in my opinion, because they're not benefiting from anything, right? They're not selling you a product, and they're not managing your money, so they can just like look at numbers only and give you projections. So everyone has particular reasons of why they're going to tell you what they're going to tell you, and this is for many things in the world. And so this is sort of why I try my best to guys just show you numbers and just give you an honest thing, because I'm not managing your money, so it doesn't really matter to me. And I want you to understand why people are so hesitant to say, hey, it looks like maybe you should just be putting a bunch of money in a savings account, because when you tell people like that, and then it's like, well, why would I want to give you my money? I'm just going to hold cash, right? This is why Wall Street doesn't want to just say, hey guys, just hold a bunch of cash, or hey guys, just be grabbing bonds, because it doesn't benefit them to say these kind of things. But that's the reality, and this is sort of why I mentioned to you guys before. It was like a week or so ago or whatever. It was like maybe it was a couple weeks already, but like, hey, when you think about your portfolio, think about lots of different asset classes, because in the past, right, many channels are just like, oh, just buy whatever stock and dog coin, and it's going to go up to crazy. But the reality, what I've been telling you guys, is worry about your job situation. Start thinking about, got to be paying off that variable interest loan / debt, because as rates keep going up, it's just the payments on that stuff is going to keep adding up like crazy. And this is actually really fast how they're raising rates. I mean, it's nuts. We're getting closer to, now the talk is 6%, right? Basically from 0 to 6. It's funny. It's like 0 to 60 in 3.2 seconds in terms of a car or whatever. And then this is like 0 to 6 in like a year or so. So this is the new reality that we live in. And the other one as well is like, for whatever reason, markets were thinking that the Fed is going to be cutting rates, and they've never indicated. They've said that for a long time, that we're not cutting rates this year, and they keep repeating that. And I think, who knows, maybe the market will finally believe them this time. So anyway, I'll do an update after Powell has his second day of meeting with Congress. Just wanted to share the updates of the headlines. It's really changed the mood on Wall Street and such. So thanks again for your time, everyone, and I'll catch you next video.